Time is money. Even the Martians have heard this generic slogan. But when it comes to investing, it's as accurate as it gets. You can't imagine the benefits of starting out early. That's why on The Money Flash, we'll answer why it's important to invest early. So without any delay, let's get going. Think about it like this. Money can grow money, and the earlier you start, the longer that money has time and opportunities to multiply. But hey, I get it. Investing can sound like complex and risky stuff, but listen up. You don't need a Wall Street suit to play this game. There are tons of beginner-friendly options out there like mutual funds, robo-advisors, and even that spare change app you keep forgetting about. Start small, be consistent, and most importantly, have the discipline to make safe investing decisions. Investing young isn't just about making sweet cash. It's about leveling up your savings game. Every dollar saved gets funneled into investments, and that is why you teach them young. The compounding magic. Each buck you invest grows over time. How? You know about compounding, right? It's like your money snowballs. The more you invest, the more interest it earns, and that interest earns even more interest. Over time, it's like a financial avalanche crashing onto your future self in the best way possible. If you want to see it mathematically, you can search SIP calculator on Google and then fill in the necessary parameters. Then just slowly toggle the time slider to see how your money shoots up and up as you go past that 5-year mark. That is simply the magic of compounding. It's basically like your money has superpowers and can grow big over time. Here's the thing, the longer you invest, the more those superpowers get to work. It's like you're leaving your money to train with the superheroes of finance, the compounding gods. Even starting with a small amount and adding to it regularly makes a huge difference down the road. To know the secret behind this magic, you have to understand the basics of compounding. Imagine you earn interest on your initial investment and earn interest on that interest too. It's like a snowball effect. The longer it rolls, the bigger it gets. Let's say you invest $1,000 yearly and get a 10% return. After year 1, you'd have $1,100. In year 2, you'd have $2,210. In the 5th year, you'll have $8,453. In the 10th year, $20,716. Then, when you reach the 20th year, you'll have $74,088. Guess what? In the 20th year, you have almost $75,000 only by investing $20K. Take a break to hit that like button if you find this video useful. Great job. Thank you. See how it keeps getting bigger and faster? That's compounding in action, turning a little bit of money into a whole lot over time. The young warrior mindset. When you're young, you have time on your side. If you stumble a bit with your investments, you can bounce back. But imagine waiting until later in life. Every risk feels scarier, and you have less time to recover if something goes wrong. Your 20s are for experimenting, for figuring out what kind of investor you are. You make some investments, learn from them, and get better. Plus, let's be real, if you don't start early and then try to play catch up when you're older, it can be seriously discouraging. It's easy to feel like you'll never reach your goals. More time to enjoy. Investing early means your money has years, maybe even decades to work its magic and grow. This isn't just about having a stash of cash when you're older, it's about choice. Maybe you've always dreamed of traveling the world during retirement, or finally have the time to pursue that creative project you've put on hold. Starting early helps make those dreams a reality. On the flip side, imagine waiting until your 30s or 40s to get serious about saving. Sure, you can still build up a fund for traveling the world, but will you enjoy your world tour in the 50s and 60s or in the late 30s? Man, playing catch up is harder. Retirement might mean downsizing to a smaller home or limiting those adventures you've always wanted. Starting early is like planting a seed and watching it blossom. Give yourself the gift of time and let your money work for you. That's the true joy of a long-term investing strategy. Investing in your 20s is like playing the money game on easy mode because of the tax benefits. Let me explain it. Right now, you're probably earning less than you will earn later in your career. That means the government takes a smaller chunk of your paycheck, which includes money you earn from investments. In the UK, You have this thing called an ISA. It's like a magical savings box where you can stash up to $20,000 a year. Any money your investments make inside this box is tax-free. Yeah, you heard that right. You keep all the profits. Also, there's an advantage of capital gains tax. Let's say you buy some cool cryptocurrency or invest in that startup your friend won't shut up about. If you sell and make a profit, the first $12,300 is yours with no tax to pay, just pure cash in your pocket. And don't you think that you can't do that if you live in the US? My young Americans, you have the Roth IRA power move. You contribute with money you've already paid taxes on. This might sting a little now, but bear with me, because investments inside your Roth IRA grow tax-free. Every dollar of profit is yours to keep. Here's the magic. When you retire, you take out your earnings completely tax-free. No extra bill from the government after decades of growth. Think about it. You're probably in a lower tax bracket now than you will be in your peak earning years. Pay the tax on your contributions while it's lower and avoid a bigger tax bill later. Let's say you put $3,000 into a Roth IRA every year starting at age 22. By the time you're 65, with a moderate growth rate, that could turn into over $500,000 completely tax-free. And it's a snowball effect. Your money will start making money, and that money makes even more money. Now, who wouldn't want that? You get more recovery time. If you start young and your investments hit some turbulence early on, don't panic. You've got years to ride out the bumps and get back on course. It's like a long flight. Even if you experience delays at the start, you'll still have plenty of time to reach your destination. But here's the thing. The older you get before you start investing, the shorter that runway becomes. If you don't take off until much later, any setbacks could really mess up your plans. You have less time to make up for losses. Personal finance lesson. Your brain is like a sponge when you're young. It soaks up knowledge faster. That's why learning about investing and money stuff now is a total no-brainer. Here's the deal. Your brain's ability to grasp new ideas is like a superpower you should use while you've got it. Understanding how investing works lets you make way smarter decisions with your money. Imagine this. Your friend pitches you on this wild new stock, but because you already understand investing basics, you'll be able to spot if it's a winner or something that'll end up tanking your savings. It's like having your own financial advisor built into your head. Of course, that doesn't mean you hit an age and suddenly forget everything. Learning is lifelong, but getting this head start when you're young puts you miles ahead and makes those tough financial decisions way easier when life gets complicated. Think of it as giving your future self an awesome gift. I hope you've learned a lot from this video. If you did, hit the like button and comment down at what age you started investing. For more fantastic and useful financial videos, subscribe to The Money Flash. See you in the next one.